Welcome back. Remember last session we ended by doing our statement of owner's equity, and I told you when we came back we would do the balance sheet, and in this session we'll actually complete chapter 1. So our balance sheet is shown on this page, and this balance sheet is prepared in what's called the account form. And the account form, it's because it resembles the basic format of our accounting equation. Remember our accounting equation, basic accounting equation, assets equal liabilities plus owner's equity. So we put the assets on the left and the liabilities and owner's equity on the right, and that's called the account form. And we have to make sure our left side equals our right side. That's the whole purpose for doing the balance sheet, is to make sure our accounts are in balance. So we to prepare this balance sheet, we do it just like the other statements. First line in the header, we put the name of the company. The second line, we put the name of the statement, balance sheet. And the third line, instead of putting for a period, remember I told you a balance sheet is like a snapshot. It's what the accounts looked at a specific point in time. And the specific point in time for this statement is November the 30th, 2009. And so on the left, we list our assets. And if we go back to page 14, where we listed all of our transactions, the changes in all of our transactions, we see under assets we had cash, supplies, and land. So we put the word assets kind of centered over this section on the left, and we list the account names, cash, supplies, land on the left, and then in the column on the right we list the amounts. $5,900 for cash, $550 for supplies. Remember, Chris bought $1,350 worth of supplies, but $800 of them got used up, only leaving us $550 in supplies. And then, of course, he bought that piece of land, or the company bought that piece of land for $20,000. And we add that up and we get $26,450. Our assets are normally listed according to liquidity. And what liquidity means is how fast it gets used up or turned into cash. So of course you can't get anything more liquid than cash. If you had accounts receivable, if Chris had or Net Solutions had accounts receivable, they would be listed right up under the cash, because normally accounts receivable are collected within 30 days, and some of them, the same day as the invoice goes out, the money's collected. So we got a cash, and then if we had accounts receivable, that'd be listed. And then supplies, remember Chris bought $1,350, 800 of them's already got used up, so that's pretty liquid. So we list the supplies, and then of course your land, your furniture and fixtures, your land, your buildings, those things would be less liquid and be listed after all of your current, what we call current assets. And then over on the right hand side we have our liabilities, and these are listed by liquidity. Luckily Chris only has accounts payable, so we list that. If he had notes, they would be listed under the accounts payable, because it'll take a longer time to pay off the notes than the accounts payable. Accounts payable are normally paid within 30 days. So we got accounts payable $400, and then from our statement of owner's equity we had Chris Clark ending capital $26,050. We add that to the $400 and we get a total of $26,450. And so our left side is equal to our right side. We're in balance, and all is good with the world. Our next statement is and last statement is a statement of cash flows. And the statement of cash flows serves a great purpose, because when you tell that business owner, hey, you're doing great, you made $50,000 last year. Well, what they will always say, well, where did the money go? Well, the statement of cash flows actually tells us where the money came from and where it went. So it's just what it says, a statement of how that cash flowed through the business. The statement of cash flows consists of 3 sections. The first one is cash from operating activities, and that's the cash flow from our receipts and cash payments for operations. And then we have cash from investing activities, and that would be where we invest in either buy or sell relatively permanent assets. In this case, Chris Clark, remember, he bought a piece of land. And then we have our financing activities, and the financing activities are the investments by the owners, borrowings by the company, and withdrawals by the owner. And so the first thing we need to do is go back to our page 14 and look at all of our transactions, and then categorize those either as financing, investing, or operating. Remember, Chris Clark started out with a zero cash, or the net solution started with a zero cash balance, and then Chris Clark contributed $25,000 in capital to the company, or invested that. And so that's from financing. So that $25,000 on that top line is from financing. The $20,000 purchase of the land is investments, because we're purchasing land, and it's a minus. And then we have operating income, fees earned, $7,500. So that's going to be from operations. And then we have $3,650 worth of expenses, and that's going to be from operations, of course. And then we paid down our accounts payable by $950, and so that's going to be a negative from operations. And then remember, Chris Clark withdrew $2,000, and that's from financing. So we list these on here. From operations, we had cash inflows from customers, $7,500, and then we have to deduct the cash payments for expenses and payments to creditors. So we had expenses of $3,650, and then we paid our accounts payable down by $950. So we add those two together, and we get $4,600. So we netted cash of $2,900 from operations. But remember, his net income was actually $3,050. So there is a difference there, and it's because of that accounts payable. And then our next section is cash flows from investing. And Net Solutions bought that piece of land, so we got minus $20,000 there. So if we didn't have some investments from Chris, we'd be in a world of hurt, because we'd have a negative cash flow of about $17,000. Of course, Chris invested $25,000, but he withdrew $2,000 of that, so he had a total from investments $23,000. We add these three numbers together, and that gives us $5,900, and we compare that to the amount that we saw on the balance sheet for cash, and remember, it was $5,900. So our statements are interrelated, and they all tie back out to one another. So all is good with the world. We did a great job. We got all of our transactions in, and balanced out everything and tied everything back together. At the very end of this chapter, it does talk just a little bit about financial analysis, and it actually talks about introduces ratios. And a ratio is you compare two numbers and get how one what percentage of it is to the other number. And the one that they show is ratio of liabilities to owner's equity. So remember, Net Solutions only owed $400, and Chris Clark's ending capital account was $26,050. And when you divide that $400 by the $26,050, it comes out to 0.015. And so that means for every 1.5 cents of debt, Chris has $1 worth of capital. And so remember, the rights of creditors to business assets take precedence over the owners. So creditors look at that number to make sure that it's always a good, strong number when loaning money to a company. So this concludes our chapter 1. I hope you enjoyed it, and we'll be back together next week to talk about chapter 2. Thank you, and have a great day.